everyone, and thank you for watching my videos. Investors need to know how to spot trends in this market because trends is where we make the largest amount of profit. So in this video, we're going to learn how to spot trends, how to know whether or not we're in the midst of a trend, and what do we do about it. So let's continue. So here's what we need to know about trending markets. And as we know by now, a trending market is a market in which the prices are heading in a general direction. Either they're heading up in a bull market or they're falling down in a bear market. And sometimes in the middle of the trend, the prices go the opposite way. However, there is a difference between a retracement and a reversal. They're not the same, they're different. And many new investors have a large amount of trouble distinguishing the two, whereas the advanced investors, they know how to distinguish the two. So at the end of this video, our objective is to make sure that we can determine which is a retracement and which is a reversal. Okay, so I'm going to show you a chart of what a typical trend looks like. So here we have a downtrend. Here we have a line that connects the opening volume of the first candle that began the downtrend to the opening volume of the last candle in the downtrend. Nothing new there. Okay, so now let's talk about ADX in a trending market. Now if you remember, ADX, that's one of the technical indicators in your trading platform. And it's also a good tool because what ADX does is it measures how strong the trend is. So we need to learn how to use all of these tools that we've talked about in the previous videos. But right now I want to take a moment to talk about the ADX and how big of a role it plays when we're looking for those trends. So we use ADX to determine whether or not we are in the midst of a strong trend or in a weak trend. And the way ADX works like this. There is a range from 0 to 100%. Now, when the range is higher than 25, it confirms that the trend is a real trend. So, and the higher the number is, the stronger the trend is. So I just had to throw that in. Okay, so here is what the price chart looks like with the ADX on the bottom. Now notice, let's look at the ADX chart. And here we have the 25 line. And notice that most of this green line is above 25. That tells us that the downtrend is a really strong trend. So ADX can tell us approximately how long this trend might continue. Okay, so we talked about ADX. Let's talk about moving averages in a trending market. Okay, so here we have our moving averages. They're compressing together. And if you remember from my previous lecture on moving averages, we have fast moving averages that react quickly to the market, and we have slow moving averages in which it covers larger periods, which react slower to the market. And notice that the three moving averages seem to come together here in this circle, and then the trend begins. So many investors, they use moving averages. They'll set up a fast moving average, a little bit slower moving average, and a slow moving average. And they compare the relationship between the three. And when the investors see that the moving averages are crossing over, then they examine the positions of the candlesticks. And here we have a big bearish candle right in the middle of that circle. That is a selling signal, selling signal, and investors are more likely to short the pair. Now, let's talk about Bollinger Bands in a trending market. So here's what we need to know about the about how to look for trends. Many of the currency pairs range most of the time. There's always going to be more ranging than trending. As a matter of fact, currency pairs range somewhere between 70 to 80% of the time. So if we're sitting in front of the computer all day looking for trends, we're going to be sitting in front of that computer for a long time. So keep in mind, there's going to be more ranging than trending. But don't worry though, because we can still make profits off of ranging markets. We just have to do it right. Now, Bollinger Bands are a good tool to use because Bollinger Bands, they can help us make profits even in a ranging market. And again, if you remember from the lecture on Bollinger Bands, it just tells us how much volatility there is in the market. So here's what we're going to do with Bollinger Bands. So here now, when we set our deviations, we can set them for whatever number we want. However, many trading platforms, they have default deviations. So now if you remember the video that I did on Bollinger Bands, I had a list of mathematical formulae that you can use to plug in those numbers so you have a better understanding of how Bollinger Bands work. But if you want to use the default settings on your trading platform, you can do that as well. However, some of the default deviations would be a deviation of 1 and another set of bands with a deviation of 2. Now, sometimes you can even have more than one Bollinger Band. So let's look at this chart for example. So here we have an example of 2 Bollinger Bands. One with a deviation of 1 and the other with a deviation of 2. And here's what we have. We have zones. Now remember, we have lines and we have zones. This time we have zones. And if you look in the middle, we have what we call no man's land. It just tells us that the market is ranging and there seems to be a tug of war between the buyers and the sellers, and it's very difficult to determine which direction the market will go. So many investors, they'll use Bollinger Bands in a trending market to determine which are good areas to go long and which are good areas to go short. So many investors will go long in this zone where the blue line is above the red line, where the deviation okay. So here we have 2 bands, red and blue. The red bands, the deviation is set to 1, and the blue bands, the deviation is set to 2. So between the top bands, that is a signal for most investors to go long. And between the bottom 2 bands, that is a signal for many investors to go short. So also keep that in mind when we use Bollinger Bands with these deviations of 1 and 2 to get involved in this market. Okay, so again, the sell zone, that's the area between the 2 bottom bands of the standard deviation, 1 and 2. Again, we don't have to use those deviations. Those are common deviations that many investors like to use. So, and again, the buy zone, that's between the upper 2 bands. The Bollinger Bands, it also makes it easier to confirm whether or not we have a trend based on what happens when candlesticks enter the buy or sell zones. Now, we're not paying attention to what happens in no man's land, but then again, if you are an advanced investor, you might have your own ideas as to what might happen. But if you're new to the market and you're new to using Bollinger Bands, it's best that you just wait for the candlesticks to enter the zones. Okay, so let's talk more about ranging markets. And here's what a ranging market looks like. And notice that the lines of support and resistance are parallel. Okay, now again, here we have ADX in a ranging market. So before we looked at ADX in a trending market, here's what it looks like in both trending and ranging. And as we can see, the ADX is greater than 25 when the market is trending, but lower than 25 when the market is ranging. So again, ADX can tell us whether or not we have a trend that's for real. Okay, Bollinger Bands in a ranging market. And again, here we have a 14 period Bollinger Bands with a standard deviation of 1. And again, notice that we have some ranging happening here. And notice that the candlesticks tend to gravitate more towards the middle of the two bands. Sometimes the candlesticks will test those bands as well. Okay, so here's how we make our profits in the range market. So the basic idea of range market strategy is that the currency pair has a high and low price in which it normally trades in between. And also, by buying near the low price, if the trader is hoping to take profit around the high price by selling near the high price. So in a ranging market, now remember, markets range 70–80% of the time, which is okay because we have our parallel lines of support and resistance. And also, when we use our ADX, and when the ADX tells us how quiet the market is, and when we apply those Bollinger Bands, and the Bollinger Bands also tell us how quiet the market is, many investors will do this. When the candlestick breaches the line of resistance, that is an indication that we should go short. And same thing when the candlestick breaches the line of supports, then that is an indication that we should go long. Because in a ranging market, candlesticks tend to stay between support and resistance. So, again, we hit the line of resistance, it's more likely that the prices will reverse itself. And same thing when the candlestick hits the line of support, the prices will also reverse itself. So that's how we make our profits in the range strategy with using a ranging market. Okay, and again, oscillators can also give us an indication as to how strong these lines of support and resistance are, and the likeliness that the lines of support and resistance will be broken. Okay, so let's see how we use oscillators in a ranging market. So here we can see that the prices are either overbought or they're oversold. So again, even in a ranging market, the currency pairs can still be overbought and oversold. So as we can see, a couple of times the market was overbought and oversold, and then the market corrected itself by getting away from the lines of support and resistance. As we can see, the lines of support and resistance have been breached a couple of times by the wicks, not the bodies. Same thing with the lines of support. The lines of support have been breached by the wicks, not the bodies, which means that the markets were testing those levels. But there's not enough volatility to break those lines. So again, that is how advanced investors make their money in the ranging market. Okay, so here is what we've learned so far. We've learned that whether you're trading a pair that's in the trending or ranging environment, you should take comfort in knowing that you can profit whenever the case may be. And here's what we need to know. Find out how you can pick the tops and bottoms in both trending and ranging market environments. So what we're doing is we're just looking for trends by comparing the highs and the lows in each chart we look at, whatever chart we look at. Now, as I mentioned before in the video, there's a big difference between retracement and reversal. So here's the difference. A retracement just means that the market is correcting itself. Notice I said the word correct, if you remember my lecture on Elliott waves. that just because the market reverses itself in the bull market, it doesn't mean that the sellers are stepping in to drive the prices down. It just means that the buyers that got into the market early, they saw how much profit they made. They decided that they're going to close their positions early and enjoy those profits. However, the number of buyers willing to close out their positions, they're limited, and once that limit has been hit, then more buyers will step in, because once the investors saw the opportunity, now they saw it too late. Well, they didn't see it too late, but they didn't see it early enough. Once they saw the potential, or realized that there's potential in getting involved in the market, and because of that retracement, that makes the market more attractive, and that's why that second impulse wave is bigger than the first impulse wave, as we can see. So again, it looks like we have a rally and it's time to buy. No, it's not, because we don't know the difference yet between retracement and reversal. So again, the amateur investors seem to have a very difficult time distinguishing the difference between retracement and reversal. Don't make that mistake, because the advanced investors do know the difference. So again, retracement, a temporary price movement against a trend. Now, usually the reason why the price moves against the trend is just because the ones that are in control of the market are closing their positions so they can enjoy their profits. And then more buyers get into the market to drive the prices upward, or more sellers get into the market to drive the prices downward. But a reversal is the end of a trend and the beginning of an opposite trend. So remember, retracement, reversals, they're different. Okay, so again, here we have an overall trend, and then we have 3 reversals. So as we can see, you can see the difference between a retracement and a reversal. Here we have the retracements, and here we have the reversal. Now, we have 3 options when we are dealing with retracements or reversals. If we are in a position, we can hold on to our position, or we can close our position and then re-enter. So if we're in the bull market and we see that the bull market is about to begin and we get in on that first wave, what we can do is we can close our position as the market is about to retrace, and then get back into the market after that second wave has been complete. And then we can maximize our profits even more on both wave 1 and wave 3. That's how the expert investors do it. Or you can close permanently and just say, well, I'm happy with the profits that I do have. I'll just wait for the next trend. Okay, so how do I identify reversals? And we do it by this. By properly distinguishing between retracements and reversals can reduce the number of losing trades. So we must know the difference. Retracements, reversals. We must know how to distinguish the two, and we must not make the mistake of confusing the both of them. Also, classifying a retracement or reversal is very important, as we can see. Okay, now remember, retracements and reversals. When we use our trading platforms, or the tools on our trading platforms, we can use those tools to identify whether or not we have a retracement or a reversal. And when we look at the patterns on the Japanese candlesticks, and by looking at some of the candles, such as the doji at the end of the bullish candle, or the doji at the end of the bearish candle, the morning and evening stars. So the type of candles that we see on the charts can also indicate if we have a retracement or a reversal. Also, when we draw the trend lines and we draw the channels, that can also give us an indication whether or not we have a retracement or a reversal, depending on how often those lines have been breached, and how often those lines have been tested. So remember, just like I mentioned in the last video, we have to combine all of the knowledge that we have in the previous videos, all of the tools that we have in our trading platforms, as well as our abilities to watch different candlestick patterns and also watch how the markets behave when the lines of support and resistance are breached. So again, here's an example of pivot points when we're identifying reversals. So notice that when some of the lines have been hit, the markets behave in a certain way. So again, examining how the market behaves when each line in the pivot points has been hit can also give us an indication as to whether or not we have true reversals. Fibonacci lines, that's another way of determining the difference between retracement and reversals. So again, another way to see if the price is staging a reversal is to use pivot points. So I strongly urge you to learn more about those pivot points and the different types of pivot points. If you don't understand how pivot points work, watch my video again so you have a more understanding, because we need to use that when we're investing in this market. And also, we need to learn about Fibonacci retracement. So if you don't understand Fibonacci, please watch my video again so we can apply that knowledge when we get involved in this market. So again, here we have an uptrend, and here the market is stalling between the two lines of resistance. And as we can see, one of the lines of support has been breached a few times, and here we have the pivot point. And notice that the candlesticks are hovering back and forth between that pivot point. Some of the candlesticks are above, some of the candlesticks are below. So we also have to guess what would happen. So by using this technical tool, also with the candlestick charts, we even can have a better understanding as to whether or not the market is about to reverse itself. So let's look at this chart right here. Here we have a downtrend, and here we have lower highs. And remember, when we see lower highs and when we see the downtrend acting as a line of resistance, and notice how this line gets breached, that can also give us a clear signal as to the market is reversing itself. And look what happens. So again, what we need to learn in this video is that we must learn that there is a big difference between retracement and reversal. Knowing the differences between the two can help us increase our profits and reduce the amount of mistakes that we make when we open our positions. So, and remember, we can always use trailing stops, which is when we are in the profit zone, the stop loss. Now remember, when we open our positions, always put that stop loss. We can put trailing stops, meaning our positions do move into the profit zone, our stop loss moves with it, and when the market does reverse itself, we can still have our positions closed and we can still get our profits. So use stop loss, and if possible, use the trailing stops, because the markets do change direction every so often. Thank you for watching this video, and good trading.